Welcome to this explainer on the Indian market's recent, frankly, roller coaster of a week. Look, if you were watching the tickers between May 11th and May 15th, 2026, you definitely saw a whole lot of flashing red. We're talking about intense macroeconomic headwinds and shifting corporate earnings that just collided, creating massive waves across the trading floor. So today, we're going to unpack exactly what happened and, more importantly, why it matters to you.
Okay, let's just dive right into this staggering number straight out of the gate, 96. The Indian rupee literally just breached the 96 to the US dollar mark. I mean, this isn't just a slight dip, right? This is an all-time psychological low. And with this drop, the rupee has officially become Asia's worst-performing currency of 2026.
So, seeing a historic low like that really forces us to take a step back and ask a fundamental question. What exactly triggered this sudden, aggressive market stumble? Like, how did we get here in just 5 trading sessions? To make sense of all this chaos, we've structured this briefing into 4 clear parts. We're going to cover 1, the triggers, 2, the scorecard, 3, the nuance, and 4, the horizon.
Kicking things off with Section 1, the triggers, or as I like to call it, the macro meltdown. You see, the market didn't just stumble on its own. It was hit by 3 massive macro punches simultaneously. First up, Brent crude oil prices spiked dramatically by over $3, hitting a staggering $109 to $110 per barrel. And for a massive importer like India, that immediately rings the alarm for inflation risks and wider trade deficits. Second, as we just mentioned, that historic rupee plunge past 96 to the dollar. That sparked very real fears of aggressive exits by foreign institutional investors. And the third punch? Rapidly escalating geopolitical tensions in the Gulf region. Following an Iranian vessel seizure near the UAE, fresh maritime friction basically sent global investors rushing to safety amidst some severe supply chain anxieties. Moving on to Section 2, the scorecard, looking at the index damage.
By Friday's closing bell, the picture was, well, it was pretty clear. Benchmark indices had completely erased any of the midweek recovery gains they managed to scrape together. Just look at the numbers. The BSE Sensex slipped heavily to land near 75,238. The Nifty 50 failed to hold its critical support, settling way down at 23,643. And the Nifty Bank Index? It definitely wasn't spared either, facing aggressive selling to close at 53,710. The heavy gravitational pull of those macro triggers just dragged all the heavyweights down.
And this point right here brilliantly illustrates the broader market pain that was felt way beyond just the big names. In the mid and small cap space, aggressive profit booking totally took hold. We saw a really weak advanced decline ratio. To put it in perspective, for every single mid or small cap stock that actually managed to go up, 2 went down. 2 to 1. The selling pressure was broad, and it was deeply felt across retail portfolios.
All right, let's pivot to Section 3, the nuance, focusing on Q4 standouts and movers.
Now here's where things get really interesting. It's the duality of Tata Motors. It is a perfect paradox. On one hand, you have the miss. Their net profit actually declined 32% year over year, down to 5,783 crore rupees. This was primarily dragged down by weak international margins at Jaguar Land Rover. But get this, the market didn't punish them. Why? Because their domestic passenger and electric vehicle divisions completely beat expectations with an explosive 43% revenue surge. The result? The stock actually pushed up 8%. It just goes to show you that strong domestic growth narratives can absolutely overpower international drag in a market like this. Plus, massive outliers still exist if you just know where to look. Take Sheila Foam, for example. Apparently, selling mattresses during a market panic is highly lucrative. They reported a jaw-dropping 7-fold profit spike in their Q4 earnings, hitting 91.3 crore rupees. That phenomenal 7x multiplier rocketed their stock 11% higher, completely ignoring the broader market's sea of red. And beyond Tata and Sheila Foam, we definitely saw some other major movers and shakers. ITC Hotels posted a really solid 23% jump in net profit and even declared a 1 rupee dividend. Tata Consumer soared over 7% earlier in the week on the back of a stellar 22% profit increase. Oh, and in other news, Adani Goat shares caught a strong bid, gaining up to 3%, following reports that U.S. authorities might be moving toward resolving some legacy fraud allegations with an $18 million settlement. But it wasn't all sunshine in the corporate sphere. Titan Company was heavily penalized, dropping over 6% amidst brutal selling pressure during the week's opening.
Finally, let's look at Section 4, the horizon, covering your May 18th to 22nd strategy.
So the absolute most critical variable as we look forward is a pretty simple question. Will the Reserve Bank of India intervene? With the currency hovering so precariously at 96 to the dollar, market participants are on extremely high alert right now to see if the central bank steps in to stabilize the rupee and essentially stop the bleeding.
Because of that, your marching orders for next week are all about defense. Here's your watch list. First, you need to track Brent crude trajectories closely. Any sustained stability or a spike around that $110 mark is going to dictate market sentiment for sure. Second, monitor for any signs of that potential RBI intervention on the rupee we just talked about. And third, keep a very, very close eye on the tug-of-war between institutional investors. We really need to watch if domestic institutional buying can continue to step up and successfully offset those aggressive foreign fund outflows.
Look, until global cues ease up, this turbulent weather is going to persist. The crosswinds of expensive oil, a weak currency, and geopolitical stress, they're here for the immediate future. Which leaves us with the single most important question for you to consider this weekend. Is your strategy truly built to trade smart in these storm conditions? Thank you so much for joining me for this explainer. Stay cautious, stay focused, and I'll catch you next time.